Good afternoon. I hope everyone's enjoying their lunch. I've got a great privilege in introducing our colleague, Senator Chris Dodd, who's going to be speaking today about some of what he saw during the financial crisis. Senator Dodd has had many decades of public service, and we're very proud that he joined our firm recently and has been working with our client base. He served 3 terms as a congressman for the 2nd District of Connecticut in the U.S. House of Representatives, and then a long stint in the United States Senate, where he ended up being the chair of the Senate Banking Committee and was at the center of a lot of the legislation that was put together to kind of fix some of the problems here, and has a lot of perspectives that come from that. And then after the Senate, he served as the CEO and chair of the Motion Picture Association of America. So he has now joined us, and he's going to give his remarks on the financial crisis.
Thank you, David, very much. It's nice to be with all of you today, and I thank David and others for asking me to spend a few minutes and try to reflect back and remember back a decade ago as the chairman of the Banking Committee and what we all went through. As I've listened to a couple of the panels here today, and Sheila Bair early in the morning, people remembering their participation in various events along the way. David mentioned that I was the CEO of the Motion Picture Association. I'm often asked, what corollaries or comparisons do I make between the Motion Picture Association and Congress? And I said, well, I left one group of bad actors for another group of bad actors. Rather, sort of a lateral move I made in joining that. This is a unique gathering in many ways. I want to congratulate the law school at the University of North Carolina, and I think it's delightful to have students that are in the room here today to listen to the conversation and discussion. A lot of it may sound terribly esoteric, and I'll try to share some thoughts, not so much on the specifics of the bills, although I'll do that a little bit, but rather what was going on in our minds, what were we thinking about. Those of us in Congress sitting on committees of jurisdiction, dealing with regulators, stakeholders, obviously in administration. Our colleagues obviously are very important as well. And what we're trying to achieve, what were the goals in all of this, in the midst of obviously a tremendous amount of turmoil in the country. And so I welcome the opportunity and delighted to be a member of a firm that's hosting this event. It's an honor for us that you're all here to be part of this conversation and recording it as such, so there's a permanent record of people's recollections and memories. I think that's tremendously valuable to have that for future generations. We will have other crises, for sure, I guarantee you that. And the question is whether or not we can go back and look and learn from the lessons of previous crises. We had the benefit of Ben Bernanke. I always said, while he was early on, it was a new territory, Washington, D.C. and politics, but he matured quickly politically in this town and was a tremendous asset in the process. And obviously his own educational pedigree, going back where he wrote his doctoral dissertation on the Great Depression, was a great advantage of having it at a table talking about some of these issues. So it's very, very worthwhile. So again, David, I thank you, and Richard, I thank you as well, the leader of our firm, for being a part of getting going. Ed Yingling, a good friend, I just had a chance to chat with Ed briefly. But obviously, we dealt with each other a lot when Ed was running the AVA, and I was working on the committee. I should tell you as a background, how did I end up as chairing the committee? I was elected in 1980, the year Ronald Reagan was elected president. I was only one of 2 Democrats elected that year. Knew there were 16 Democrats who lost their seat in the United States Senate in that sweep. So when I got to the Senate as the most junior member of the body, I was told, I expressed some interest in different committees. Banking was not one of them, I will tell you. But banking, I was told, was the only one, and a seat on the Foreign Relations Committee. Those are the 2 slots that were available to me. And then I went on to the Labor Committee. And so the next 28 years, I was the ranking Democrat, ultimately, on 3 major committees of the Congress. But I happened to be sitting next to Paul Sarbanes, Ted Kennedy, and Joe Biden. None of them were moving anywhere. And as you're a Democrat in the pecking order, in the food chain, you can only hope that your good friends and colleagues lose or die along the way in order to move up. So for 28 years, I sat next to these 3, and all of a sudden, within a matter of months, sadly, Ted Kennedy passed away, Joe Biden became vice president, and Paul Sarbanes retired. So at that point, I had the choice now to chair the Foreign Relations Committee, the Labor Committee, or the Banking Committee. And it would have been normally, under normal circumstances, I suspect I might have chosen the Foreign Relations Committee or the Labor Committee. I did a lot of work in both. I'd served in the Peace Corps in Latin America back in the 60s, had a strong interest in that part of the world. But I could see in 2006 there was already movement occurring of the importance of this issue. I've listened to some people talk about how no one saw this coming. I don't think anything would be further from the truth. A lot of people saw it coming, were talking about it. In fact, there were hearings in the Senate Banking Committee. When he was chairman of the subcommittee, Senator Bunning of Kentucky and Jack Reed had hearings on the emerging housing crisis in the early part of 2006. And so even a year before I became the chairman of the committee, when the Democrats took control of both the House and the Senate, there was already a debate and discussion occurring about the importance of the issues. Anyway, what I thought I would do today is share with you some of the motivations in three little pieces. One is what we're thinking going on prior to September of 2008. How did the TARP legislation come together in the effort to achieve that? And then, of course, what did we try to do in putting together the Dodd-Frank legislation? Let me just say at the outset to you, having served in the Senate, I had great affection and love for the body and the members I served with. I did not write the 10 Commandments. We wrote a bill. I had to produce 59 other supporters in the Senate, half the House of Representatives, try to at least keep stakeholders, the administration, the regulators, all harnessed. I love hearing people who get up on a podium and tell me what we should have done. And I appreciate that. Everyone has their right to express it. But you go out and find 59 senators. To be for a Mother's Day resolution, it gets hard, let alone something as complicated as we're trying to do here, not to mention all of the other people who are part of it. And I really regret very deeply some of the language that's been used to describe people coming out of the financial services sector. It's deeply disturbing to me. It's a critical component, obviously, of our well-being as a nation. And we can have our disagreements with people and what they were achieving or trying to achieve. But I don't think it serves anyone's interest to engage in the kind of language that too often contaminates the ability to have intelligent conversations about it. And I'm worried, candidly, when I look over the body that I once served in, and I begin to see the corrosive character that's taken over the institution, where the kind of language that we would have relegated to a handful of people is becoming pretty commonplace, not only with how they deal with each other, but deal with complicated issues as well. And that deeply troubles me, and where we're headed with all of that. The days of moderation, at least with some people who were trying to maintain the balance in there, are almost all gone. It's a whole new configuration. And so we're not out of the woods at all in these conversations. And the assumption of the people in the past who've been more moderate on some of these questions, today I think most are gone, in a sense. And so we're looking at a whole different group. I just say that as background for you, and the willingness and acceptance that there'll be changes and should be changes to the Dodd-Frank legislation. I have voted against naming the bill Dodd-Frank. It was about 4 in the morning, and we had finished the bill, or finished the conference report, and Congressman Ken Jaworski of Pennsylvania made the motion to call this bill the Frank-Dodd bill. And Barney Frank, never without a sense of humor, even at 4:30 in the morning, said they'll think it's just one of us who wrote the bill. We can't have that happen. He said we got to call it Dodd-Frank. There was a vote. I voted no, but we ended up with the Dodd-Frank legislation. I don't know why it is historically that in the financial services area, names are attached to bills. So you have, of course, Glass-Steagall, Gramm-Leach-Bliley, Sarbanes-Oxley, and of course this legislation as well. But that's the genesis of how the bill was named. Well, let me go back just briefly because I think it's important. I mentioned some of it already, the early hearings that went on, the growing interest in the subject matter. When I became chairman in January of 2007, in the year of 2007, I held 90 hearings, formal and informal hearings of the Banking Committee on this subject matter. Some of you may have participated in those early engagements, those early efforts to sort out where we were headed with the issue. There was testimony, a lot of which was considered exaggerated testimony. I remember one estimate that the foreclosures would be somewhere in excess of 1 million in the country, and there was editorial comment that was hyperbole and trying to frighten the country in terms of what may occur. And I'm sure each of you here in the room who are familiar with those days can add to the anecdotes of what went on in the early days. I remember very vividly, of course, what happened in March of 2008. I was heading that night for a meeting of the central bankers in Europe and elsewhere, and got on a plane to Dulles, not knowing the outcome of what was going to happen to Bear Stearns over St. Patrick's Day weekend. Only when I got off the plane in Geneva that I was told what had occurred that evening with J.P. Morgan, and Bear Stearns. But even with that, the assumption was it was one-off. This was not any indication of anything that was more widespread. And I think all of us looking back, obviously even before Bear Stearns, there was plenty of evidence. And I don't know who said that earlier today, but I happen to agree with him. I think we could have, had we earlier intervened in an intelligent way, we could have avoided what happened with, obviously, the TARP legislation, what happened in the summer of 2008, and I think dealt with it in a far better way than ultimately we did, at least initially. So I'm to always remain disappointed that more steps were not taken earlier on to step in and try to figure out ways to deal with the issues along the way. So those days were a lot of gathering information, but not much was happening. And then you have the evening of September 18th, which is seared in my memory and will be forever, when Hank Paulson, Ben Bernanke, Chris Cox from the SEC, and others met with the Republican and Democratic leadership of the House and the Senate in Nancy Pelosi's conference room on the Capitol, along with some staff and other members who were interested in the subject matter. And as long as I live, I'll remember the following line. It's almost verbatim. Ben Bernanke said in that very quiet voice of his, he said, unless you act, talking to the 14 of us in the room, within the next few days, the entire financial system of this country and a good part of the world will melt down. This was not some speech given to a radical audience. This was the most important central banker in the world addressing the leadership, Republicans and Democrats of the Congress, with a rather dark and forbidding a statement about what could happen very quickly. The oxygen left the room, as you might well imagine, with that statement. Not a person, by the way, despite even the tone of his voice, but to engage in hyperbole. But I remember John Boehner got up and said, we're no longer Democrats and Republicans. Let's do whatever we have to do here to be supportive. Coming out of the room, there was a brief press conference in which there was this expression of solidarity to come together and work on the issue together. And within a matter of days, in fact, my staff did not wake me to tell me this until about 6 in the morning. But about 1:30 in the morning, within 2 or 3 days, I received a bill, a 2.5-page bill. The 2.5-page bill, not a memo, a bill, said I want $700 billion. I want no regulator, no court can intervene. That was the proposal. Well, you can imagine the warmth with which that was accepted in the country and here. And people running around and saying, what a great idea that is to come up. Judd Gregg, who was a great friend and colleague, Judd was my partner because Barney Frank and I were asked. I should point out Jimmy Siegel, who you're going to hear from later, of course, worked with Barney for years in the House Financial Services Committee. Judd Gregg and I went to work on this proposal. It took us about 2 weeks to do so. Instead of being a 2.5-page, it was about a 100-page bill, and we got through with it on the TARP legislation. And I say this respectfully of Hank and people involved. This was a difficult time, and people were doing the best they could under the circumstances. But the idea of asking for $700 billion with no oversight, in effect by a regulator or a court, the idea of purchasing toxic assets, that was a brilliant idea. I don't know who was going to either price those or whether or not you endear yourself to the American public by suggesting with their money you were going to buy bad assets along the way. That was a warmly felt note as well to get. And so we worked on this. We changed it. The injection of providing equity made all the difference in the world. We insisted upon some language, God forbid, that consumers, borrowers, homeowners might be mentioned in some way to provide relief for them as well. That was included. The warrants, which we didn't think at the moment would make any difference at all, but turned out for the only reason we got anything back in a long way was we included that provision in the bill. We had the oversight that was required, tranches, so you weren't voting once on this, but rather break it up to see how things were moving. We insisted that part of the resources could be used for things other than just equity into financial institutions. And Chrysler and GM, in my view, wouldn't be here today if we hadn't been able to put $85 billion into those companies because of the TARP money that came out. On October 1st, I asked the entire Senate to vote from their chairs. We only do that normally on votes on Supreme Court nominations, constitutional amendments, critical kind of moments. Only happened maybe 4 or 5 times in my 30 years. But that night, on the 1st of October, I asked for everyone to vote from their chair. I thought the moment was that significant that we ought to take it that seriously, I had a head count, confident of it, 75 to 24. Ted Kennedy was dying and missing that evening for the vote. What I did is something that not many people have ever told this story, but I'll tell it to all of you here today. I went around to the Republicans and Democrats who were up in 40 days and went to them, each of them, and I told them that I had 75 votes and that if they wanted to vote no on the legislation, their names would never cross my lips as having decided to make that decision. But I had no doubt in my mind that this was, without any question, the most unpopular piece of legislation at that particular moment I had ever been involved in. And I will go to my grave also believing maybe the most important piece of legislation that we ever passed, certainly in my tenure in the Senate. Each member I went to rejected the offer. I'll tell you specifically about Gordon Smith, my Republican colleague from Oregon. Ron Wyden, his colleague, was going to vote no on the bill. I went to Gordon Smith and said, Gordon, I've got the votes here. You've got a tough situation. You're up in 40 days. If you want to take a pass, you can do so. This will pass without your vote. And I'll never forget his answer to me. He said, it's a great offer, teasing me a bit. I appreciate it. But I said, I've got to face a constituent in the morning. I said, really? Who the hell do you have to face in the morning? He said, the mirror. I said, the mirror. I said, the mirror. He said, because I happen to think it's the right thing to do. 40 days later, he lost his seat. Bob Bennett lost his 2 years later. Kay Bailey Hutchinson may have lost the nomination for Senate in Texas over the TARP vote. Congressman Castle, running for the Senate in Delaware, the big issue for him was the TARP vote. Ended up with that opponent, and Chris Coons ended up winning that seat fairly easily. I think the difference in outcome. And there are many more races. But that vote lingers on in people's minds. It's seen as a bailout because that was the perception of it, when in fact we did a lot more, as I tried to explain, the things we included in the bill to make it broader, to make it more successful, as I think it proved to be over in the coming years. So as a background, just to share what went on in those days and how it came about. So the toxicity, the equity I mentioned to you, the foreclosure assistance, the warrants, the oversight, the auto assistance, along with the tranches made a big difference in my view, and we're benefiting from it. Someone made the point earlier, it's an awful way to make money, but nonetheless, it proved to be extremely valuable. Now we complete that, and the question is, what do we do in the wake of it? I don't know of anyone that believes we ought to leave the architecture of the financial services structure as it was in the fall of 2008. Many people have been arguing over the years that we needed to reform the regulatory system. It was not a new idea, but typically in Congress doesn't react unless there's a crisis. I never would have gotten close to passing something like Dodd-Frank in 2007, even in 2008, and you never could have passed it in 2011 or 12. The one window that opened up was the window we went through to try and do something. That's as long as it lasted. And if you don't get through that at that moment, then it doesn't happen. I should have mentioned on the TARP thing, by the way, in this sort of environment we're in today politically. Now, can you imagine today a circumstance where here we were, the democratically controlled House and Senate, we had the George Bush presidency, a national election a matter of days away, with the country in turmoil and financially sort of collapsing, and yet we all pulled together to write something and get something done to save the country going forward. I'd like to believe that could happen today. Reverse the roles, if you will, of party affiliation in the White House or the Congress. And I'm hard-pressed to imagine something like that happening, which saddens me deeply, that our ability to come together, whether you agree with every provision or not, the idea that we actually could come up with some ideas here, get the votes necessary, and go forward. But having done it, I honestly believe that we also had an opportunity then now to deal with the architecture in a way that would sort of mirror to some extent what had happened in the 1930s, where three great ideas, I think, bought us decades of relative stability and peace economically. The establishment of the Securities and Exchange Commission, the establishment of the Federal Deposit Insurance Corporation, and Glass-Steagall in those days, I think made a great difference for the country coming out of the Great Depression going forward. Obviously, a lot had changed. A lot was occurring, as it should. New ideas, new products were emerging, new technologies emerging. Consumers wanted one-stop shopping if they could. They didn't want to have to go to their insurance company, their real estate broker, and their banker. They wanted to be able to have greater efficiencies in their system. And so with Graham Leach Bliley, on an overwhelming vote, we got rid of Glass-Steagall. And if one more person tells me if it had Glass-Steagall in, then we never would have been through the crisis in 2008. They don't know what they're talking about. Glass-Steagall could have been there on steroids, and it wouldn't have made any difference in terms of what we went through. But the idea of having an ability to manage the new technologies that emerged, the new ideas, was critically important. So the idea is, how do you go forward? Well, I drafted in the fall of '09. I'd also become, in January of '09, the acting chairman of the Labor Committee. Senator Kennedy was dying at that point. I was his ranking member. And so for almost all of '09, I was holding the hearings, the markup of the Affordable Care Act from the Labor Committee perspective, the more important committee, larger piece of the action on that bill, but the Labor Committee provisions were also critically important. But in November of '09, we were wrapping up the health care debate. I proposed a draft legislation of financial reform. And I simply was, I eliminated virtually the entire regulatory process, established one prudential regulator with consumer protection in the same regulatory body to complement each other on matters going forward. I got 3 votes for that idea. So the appetite for doing something that was going to radically be different than what existed along the way. Nonetheless, we went forward and with the hearings in the fall of 2010, and ultimately passed the legislation in July, and then the president quickly signed it. There were certain things in process that I wanted to try and do with the bill. Aside from the substance of the bill, this was coming in the wake of the health care debate, which had caused such toxicity in the political environment. So coming with a major piece of legislation, a matter of weeks after having voted on Christmas Eve at 7 o'clock in the morning on a health care bill in the Senate of the United States, and then within 6 or 7 months try to arrange and pick up support for the establishment of the support of a piece of legislation like this. I should tell you, in my 30 years in the Senate, I rarely had a bill that did not have a Republican partner. I didn't understand what was the point of having one with just your own name on it. I shopped this bill we're talking about in its infancy before it had much of what's included in it. Richard Shelby's a great friend. We've got along. We have dinner still to these days. Had literally no interest in getting involved in this subject matter. He had always voted against these kind of propositions, was against Chrysler bailout, New York, going back over the years, had no interest in being a part of something of this magnitude, which involved this much taxpayer money. Jim Bunning was there, obviously, wasn't going to be terribly interested in the subject matter. Bob Bennett, I wanted very much to be my partner. We'd done a lot of work together, but Bob already was feeling the heat in light of his TARP vote, and lost his seat, as many of you know, within a matter of months later. Mike Crapo, who I like and admire, much of what he's done already and how he's handling the committee, was not terribly interested. Bob Corker became my partner. Bob Corker had been in the Senate about 18 months at this juncture. So I had to go 5 deep on the banking committee to find a potential partner to work on this bill. And Bob did a great job for a while, but ultimately was not senior enough there to be able to carry the day in many ways, but made significant contributions. So I wanted it to be nonpartisan. We wanted an open process for the markup and going forward. I wanted to make sure stakeholders could be heard. Every single industry that wanted to see my committee and talk about ideas to include or exclude could see the office and meet with people in the office along the way. And certainly that was true of my colleagues as well. And any ideas they brought to the table, the public hearings we had on it, and ultimately a markup, which was very brief because Dick Shelby had no amendments to offer on the day of the markup. We came along with it. So we did that. It was an open process, and at least we tried to make it as nonpartisan as we possibly could, with stakeholders and colleagues being informed that was there. The goals were, and what we were trying to achieve with this bill. Well, I mentioned 4 or 5 or 6 of the goals as they were. One is, and I know they can't legislate this, but here we were as a country, for years had been the leading nation in the world in financial services, largely because of confidence in ways. I always remember a conversation I had years ago with a manager of a sovereign wealth fund and asked him why he parked as much of his nation's resources in our country. And I'll always remember his answer. He said, for 2 reasons. One, you're very good at making money. He said, but the second reason is almost as important as the first. I've never lost a moment of sleep worrying about the safety and the soundness and the fairness of your system. I may have lost money, may have made bad bets, but I never lost a wink of sleep over the soundness of the architecture and the structures of the financial services industry in the United States. So I was determined to see us recaptured. Confidence was shattered. You can't legislate it, but like a lot of other things, people will sense it and feel it based on what you do going forward. Secondly, and you've heard about a lot of this already today, but the capital standard had to be raised. In my view, liquidity was also terribly important. We had to deal with shadow banking. It just couldn't be limited to those institutions that were de facto legally a bank. Were going to be important. Oversight was important. It seemed to me the FSOC was going to provide not only the ability to look over what was occurring with product lines and as well as threats to the industry were terribly important. The derivatives market, the transparency was important. Had to be some additional regulation of that market if we were going to be able to go forward intelligently. So these were some of the major reasons. We wanted to deal with too big to fail, needed orderly resolution. Sheila Bair talked about that this morning, the Title II of the bill, to make it work well. And so, and lastly, I would say that, again, sort of like global leadership, which many of you have talked about and mentioned, and that is confidence and optimism and trust in the process. And I would argue that today we're largely back from that. People will argue about provisions of the bill, but I think the confidence, certainly the condition. I was told that the profitability of financial institutions would disappear, lending power would be gone, and today many of you, I'm sure, are very much aware of statistically where the profit margins are and the balances are in terms of borrowing going forward. The industry is in good shape. You can't have someone announce that our economy is the best it's ever been and simultaneously talk about how bad the financial services sector are. If the financial services are in trouble, the economy is in trouble. You can't have it both ways, in a sense. So I'd like to think, and you can argue with us or tell me otherwise, but I think we're in far better shape today because of the goals we had, what we tried to achieve. Something else I did. I was hoping not for duplication, but for cooperation internationally. In April of 2008, the G20 came out with about 20 recommendations for reform of financial services globally. You can only imagine if I announced that I was looking at a foreign set of ideas to incorporate in national legislation, which I didn't. But I kept an eye on them because I thought if we came out of this, well, someone's going to lead on this. If it's not us, it's going to be Europe, it's going to be someplace else. And if we're going to lead, I think we ought to be able to try and put together some proposals here that could be duplicated or at least shared with others. That's happened in some cases, not enough, but the idea was certainly behind it to move in that fashion. So those were the ideas behind the bill and moving forward. Again, 60 votes. It was terribly difficult. Senator Kennedy died. Scott Brown was elected, the Republican from Massachusetts. Senator Feingold announced he was against the bill. I wasn't going far enough at all. There were others who thought we just didn't take advantage of the moment as if somehow that were going to pass. And so how did I come up with 3 votes? Well, Susan Collins of Maine, along with Olympia Snowe and Scott Brown, decided to support the bill. And as a result, we made just the 60 votes to get out. The House adopted it, and the President signed it into law. And again, I'll just sort of share with you here, the Consumer Protection Bureau, which I apologize, I should have mentioned that earlier, was terribly important in all of this. That again, the bill, I didn't agree necessarily in raising the threshold from to 250 billion. The 50 billion mark that was in the bill, I only wrote that provision in because my Republican colleagues kept accusing me that too big to fail was alive and well. So I kept on lowering the number to the point where they finally couldn't argue with me any longer about whether or not we were effectively dealing with too big to fail. So we didn't write that specifically to put that part of a threshold on that kind of supervision. But I thought 250 was too high. Personally, would have made it around 150, whatever. And the Federal Reserve Bank, of course, has the authority between 150 and 250 anyway. And I think Jay Powell is a great choice to be heading up the Federal Reserve. I've chatted with him about it, as I have the new head of the Securities and Exchange Commission, who I think is tremendously talented as well, and we're lucky to have those 2 people, even though I disagree with their party affiliation necessarily. I think they're very good people. The Consumer Protection Bureau, again, has been highly controversial. If I had gotten rid of the Consumer Protection Bureau and eliminated any provisions in dealing with executive compensation, I probably could have gotten 85 votes for the bill. Those 2 provisions. I'll never forget a meeting at the Willard Hotel with the largest representatives, the leading representatives of the 13 largest financial institutions in our country. And I spent an hour talking to them. They wanted me to hear two issues. They wanted to make sure there was no consumer protection and that there would be moderate positions on executive compensation, the only two. And despite the fact I brought my senior staff for the meeting on the assumption we'd have a deep conversation about the derivatives market and a variety of other things, that I thought I have professional staff who would understand it better than I would coming in. But the only two subject matters we talked about for an hour were the two I just told you about. And today, the Consumer Protection Bureau, I think, has made a difference. Again, I understand that you need to watch all the time how it works, but I think basically are doing a good job. And again, if you're going to maintain and sustain the support for the financial services community, it can't be done in isolation. Consumers need to feel that confidence as well, that we're working for them, trying to provide the liquidity, the asset availability, and so forth, for them to take advantage in life. I think that's so important. I've been a strong supporter of home ownership, and I got carried away, in my view, way beyond where it should have been, but it's been a great wealth creator. It's stabilized neighborhoods, improved the quality of life for millions of people in this country. And again, providing mortgages to people who couldn't afford them, or suggesting they could through adjusted rate mortgages or liar loans and the like we had, of course, was a terrible disaster, in my view. And it caused a tremendous amount of problems. But the basic goal of home ownership, I still think, has great value in the country as a wealth creator for families and the stabilizing influence it can have. Anyway, that's a rather rough, quick overview of going from 2005 or 6 through those years, concluding in 2010 with the adoption of the legislation that brings us here today. And I'm hopeful that there'll be further examination of the issue. It's certainly gotten global attention. I was in India in part of my previous job, and had met with the central bank. And the central bankers, two of them, were asking very detailed questions about the bill. And I asked them, how do they know so much about it? And they pointed to the television. They said, we watched the entire markup and debate on the floor of the Senate here in New Delhi. And when I was in China several years ago, the head of their central bank asked if I'd come by and talk about the legislation. I went, and there was a room full of young technicians he had working for him. But the first thing they did was present to me a word-for-word translation of Dodd-Frank in Mandarin. Now, there are people in this country who thought the original draft was in Mandarin along the way. But just to give you some idea, and they spent 2 hours grilling me about various provisions in the bill. And I probably signed about 100 copies of the Mandarin version of Dodd-Frank in Beijing. No one's asked me for that many of the English version of the bill, by the way, along the way. Anyway, you're patient to listen to all of this. I hope I haven't bored you and going back and talking about the TARP, the run-up to TARP, and, of course, the thoughts behind the Dodd-Frank legislation. And again, I know many of you here lived all through this and made a difference. There were moments I didn't bother to address, the White House meetings with John McCain and what happened with Hank Paulson those days and so forth, but I'll leave those for another conversation. But thank you all very much, and thank you for inviting me to come by and do this. Yeah. Be glad to duck any, yeah. That seems to be the table with questions back there.
Great.
You've got to move, though, Mike. I know. I know you do. I know you.
You obviously had to make compromises along the way. Is there any one thing that didn't make it into the bill that you personally would have very much liked to have seen in the bill?
Yeah, I would have, as someone's mentioned it today, I would have loved to see us deal with Freddie and Fannie, the bill. But as Judge Gregg, I'll quote him for you on the floor of the Senate, because we got asked every day about why we weren't doing it. And we tried. There's just some things you can't get done. And a lot of it was an ideological difference as well. I mean, there are people who vehemently oppose the federal government being involved in housing finance. And so it's not a question so much of substantive debate. I'd like to see it changed. I think it'd be easy to get a compromise if you could get people to come together and create more of a utility out of it, where you don't have the competing ambitions of making money on the board and also dealing with the housing needs of worthy consumers in the country. But we just ran into a wall on it, and rather than drop the whole bill over it, we just said, well, some will get done pretty quickly. Well, that was 10 years ago, and they're still talking about it. But that's one. I think the Volcker rule, in a sense, this is one where maybe got a little bit out further on our skis without really thinking how it could work well. That would have made some differences. There were provisions in the bill. I've had audiences ask me, what the hell were you thinking of by including provisions in there dealing with the extractive industries in Africa and the Congo? What has that got to do with financial services? Well, for those of you who follow the work in Congress, I'll tell you the story very quickly. The Biden strident advocate for the Congo and the extractive industry was Sam Brownback of Kansas. No liberal Democrat, I can guarantee you. And Sam came and said he'd like to have a provision in the bill to deal with the Congo. Well, being a pretty good legislator, I said, well, Sam, I got a pretty important bill here, and I'd like to we could have a little support on the legislation. He said, well, I'm thinking about it. So I went to Richard Shelby. I said, Sam's got a great amendment here. I think it's fine. I think we can accept it. We took it on voice vote. Dick Lugar had a similar amendment dealing with all of Africa and the extractive industries. And I thought, well, that's not a bad idea, but Dick, I've got an important bill here. At least give me some consideration. Absolutely, give you some consideration. We took that provision and put it in the bill. Neither one of them voted for the bill, but I've got the Congo and all of Africa and the extractive industries. So you end up with things sometimes. If you're dealing here, I mean, I literally was negotiating as the vote was occurring on the, in fact, Barney was a great help. I think Barney was in the House gym when the vote was occurring, and I tracked him down because a colleague was insisting that we have a provision in his state that would be moderated the relationship. And again, I'm at 59 votes, and the vote's occurring. And without Barney's support, it wouldn't have happened. But Barney said, no, do it. It's fine. We'll work our way through it in the end, and did. But nonetheless, you're dealing with that many people and that many issues on the complicated subject matter. I heard someone today talking about financial services and financial literacy with the general public. If nothing else occurred during this, the financial literacy of members of Congress went up a bit. But I got to tell you, it's still pretty bad, and I say that respectfully. They'll talk about everything in the world, and they'll want all sorts of jobs to be Secretary of State and Secretary of Defense, President of the United States. Not too many want to run the OCC or the FDIC or something else along the way. Anyway, that's sorry, longer answer than you planned. Yeah.
I want to take you back to TARP again, where we started before, and I find it very inspiring, the story of everybody coming together at this crisis situation in order to, put country before politics and party and do the right thing. Yeah. And I guess my question is, how do you manage, or how should it have been maybe better managed, the fallout from making an unpopular but wise decision in a time of crisis? Because as you pointed out, a lot of the people who got on board with this and probably needed to get on board at the time ended up having political fallout later, and it's changed the distribution of power, and the people that are at the table, as you mentioned, who maybe don't have the same kind of experience or the same sort of willingness to collaborate. And how is it a problem of the media? Is it a problem of communication that was mentioned on the prior panel, communication with people to make sure they understand why Congress is doing what it's doing? Is there a way that we can learn from the negative fallout from TARP to do better the next time we have an unpopular but important thing that government must do?
Yeah. Well, it's a great question. I don't think there's any single or short answer to the question. There's so many variables that contribute to all of it. I happen to have been lucky that have a partner in Judd Gregg. We worked on a lot of stuff together. That made a big difference. I think, and Jim may tell me otherwise, but there was less of that. Obviously, in the House, there's not as much cooperation between the two parties because you don't have to. The majority rules are there. In the Senate, if you're going to do anything, even when you have super majorities, or could have it, you've got to work more closely, or nothing happens at all. I think leadership is terribly important. I know the constant conversation these days is the trouble the country's in. I don't have to say much more than that. And this is troubling times in many ways. But what's missing to me is not that they're troubling times. We've been through a lot of troubling times, more troubling than this, candidly. But leadership. You've got to have leadership. And if there's a void in that, then you have a real problem of pulling things together. There got to be people at the top of that system who are willing to allow you to work and get the job done, in a sense. And so having Barney Frank in the House side was invaluable. Barney's highly regarded, respected. So having Judd Gregg, having Barney, having Bob Bennett, who was terrific, having Bob Corker along the way was tremendously valuable. I was lucky to have some people who wanted to make this happen, who were regarded. Judd Gregg was highly respected in the Republican conference. And so when Judd talked about getting this done, made a huge difference in moving forward. Bob Bennett made a huge difference. Bob Corker did at that particular moment. So I was very lucky, and I had some tremendous support among Democrats who were skeptical, quite candidly. What in the world are we doing? We got a chance to win this national election in 40 days, and we're pulling George Bush's chestnuts out of the fire? I mean, Franklin Roosevelt let Herbert Hoover dangle until March of 1933. What the devil are we doing this for, 40 days before a national election? What political judgment are you showing at a moment like this? We can win hands down, pick up many more seats we would have gotten. Country will be furious at their mismanagement of the economy on this. But to the credit of people I served with, there was an honest belief when Ben Bernanke said, this is how dangerous this is, that we took him seriously. And so made the effort to do something that would not only get passed, but could make a difference. And I realized that we didn't know for sure it would, even with what we drew up, whether or not that would work or not. It turned out to be way beyond our expectations. That some have mentioned already, the terms of resources that came back to the American public as a result of putting warrants into the TARP legislation, for instance. So those are all factors. The media had a tendency to focus on what was, sort of a hot story here and there along the way, but to a large extent, they, I think, understood. I think the editorial comment about TARP was pretty favorable at the point we actually voted on it, as I recall. Yeah, I wouldn't quit without you asking a question. Academicians are always fun to listen to.
You know us well, thank you. So the bill bearing your name is sometimes characterized, if you like a two-word summary of it, as an anti-bailout bill. And indeed, when President Obama signed it, he said something like, I believe, Main Street would never again be asked to foot the bill for Wall Street's mistakes. Yep. When I hear, however, your emphasis on what you were trying to do in the statute, and also when I look substantively at what's in the statute, it doesn't seem to be primarily focused on preventing bailouts, although a reduction in risk that might lead to bailouts could be one of the benefits of it. So I'm interested in your view. Do you see yourself as one of the main goals in that legislation is trying to prevent things from TARP from ever being, for example, necessary again? Or do you think the anti-bailout spin on what you all did was a little bit misleading, but maybe had some political advantages to make it more acceptable to, given the anti-bailout outrage amongst voters?
Well, again, I get lectured all the time, but I always felt somewhat comfortable when the left tells me I went not far enough and the right says I went way too far. That's a fairly good piece of evidence that I'm probably in a safe space along the way. But putting aside whether or not you feel safe about it at all, I listened to Sheila this morning, and I agree. I think Title II is terribly important. The orderly resolution. I was mentioned earlier the question about what I would have added or subtracted. I would have liked to have had some reforms out of the Judiciary Committee on bankruptcy legislation as part of the bill. We didn't do that, and that's a gap in my view. We haven't been tested yet on this. But the FDIC had experience, obviously, in orderly resolution, do it every week, and the country doesn't get rattled. The banks close on a Friday and open up on Monday, and consumers and borrowers are protected. But what she was wrong about, in my view, it's against the law today to do what we did. You can change the law, but the idea that you can go in and take advantage of some provision of law and provide the kind of support we did for TARP, or the suggestions otherwise, not the case. In fact, Barney the other night we had a meeting with a lot of people from Ben Bernanke and Hank Paulson and Tim Geithner. It was a big gathering and dinner. And at the end of it, after the speeches were given, Barney said, "Can I ask one question?" And he took the microphone and he turned to Hank and others. He said, "Tell me, how's that bill working out to allow future bailouts?" The thing, and of course they all laughed. There is no bill, and not likely to be. So putting aside the substantive, can you imagine today, in this climate, of proposing something like TARP, even if you had the right to do it? I think all of us are going to be long gone before people try something like that again, even if you legally could. Now, again, I get asked all the time, why didn't more people go to jail? Well, first, you got to break the law to go to jail. You can disagree terribly with what people did, the ethics of it, the morality of it, and everything else. And that's perfectly legitimate. The banking committee doesn't have jurisdiction, not necessarily of criminality as such. And as a practical matter here, that was not our function and job to do that. And I don't happen to believe that even if you had written provisions, whether or not it would have occurred. Can be furious over what happened. But the idea that there was actually the breaking of some laws, others will make a case differently, but I've always felt that was doubtful in my own mind. So we concentrated so much on really the ability of putting in the position the tools to give you the opportunity to spot these problems emerging far earlier. You could argue the tools already existed, but I'll accept the notion that they just didn't appreciate the depth of the problem early enough. But now with FSOC, with the other requirements in the bill that we've talked about, with the transparency in the derivatives market, with the oversight that we're requiring in other functions along the way, I think there's a much better opportunity to spot problems. Now, if they don't want to deal with it and they don't take advantage of the tools, I can't condition that. I didn't like writing as big a bill as we did. 1930s, the bills were 25 pages long. Gave everything to the regulating market. And I couldn't sit there and ask 51 to 49 vote in the Senate on an issue involving a swap. With all due respect to my colleagues, they don't know what the hell you're talking about in most cases. And so you really have to defer to professional people to make those kind of decisions. So I would have preferred a smaller bill, but I thought the responsible thing to do was to turn over a lot of this with some clear guidelines over to the people who knew what they were doing on a day-in, day-out basis. Anything else?
Senator Dodd, please join me again in thanking
Thank you
him
all
for
very
a
much.
terrific
Enjoyed it.
remark.
Yeah.